Hello, this is Akshita from Finetix Financial Services. In the next few minutes, I am going to take you through the key events of recent past on equity markets. After 3 consecutive months where markets corrected, April saw a meaningful bounce. Markets were up by about 6% in India in April. Most of the global markets also went up during this month. After the banking scare in March led by regional banks in the US and Credit Suisse in Europe, markets rejoiced, some calmness returning back. Global energy prices also softened during the month and markets reacted to corporate earnings, while there have been fears of global recession in the making. Recent US GDP growth as well as the US corporate earnings point out to renewed resilience in the US economy. Indian markets also reacted to earnings print as well. While it's still early days, initial trends from the banking sector points towards continued strong earnings momentum, while IT sector saw weaker than expected earnings. Over the next month, as broader markets earnings get released, one will have a better sense of near-term earnings outlook. There have been mixed views on prospects of monsoons in India, while private forecasters climate predicts a below than average monsoon. The Indian Meteorological Department forecasts monsoon to be in line with longer-term averages. Basis indicators like FMCG industries sales trend on a post-COVID trend line to a pre-COVID trend line. It does appear that rural India is taking longer to get back to earlier consumption trends, and so a lower than average monsoon can further push the rural sector recovery. April continued the trend seen in March 2023 in terms of institutional flow activity. Both FII and DII have been net buyers of Indian equities. Valuations have moderated a bit as markets have consolidated over the last 18 months. These 18 months have also seen significant macro shocks and unprecedented war in Ukraine, spiking crude over up and above $100, significant FII selling, hike in global inflation and interest rates, etc. It does appear that the rate of change of many of these macro variables is settling down. The overall health of balance sheets of corporate India is in very good shape, and overall we are seeing capex by corporates, which was in the slow lane in the last decade, firmed up. Capex today is the source of future stream of cash flows and profits tomorrow, and so it's important to see the continued strength in the investment team by corporates, and so while the medium-term prospects of corporate India remain intact. In the near term, we do think that the sentiment of the local state elections as well as the run-up to the general elections in 2024 is likely to keep the markets volatile. Given that ups and downs are part and parcel of asset classes like equities, it is only natural to expect sustained volatility in the times ahead. However, rather than obsessing over the fear of fall, we would encourage investors to use such opportunities to increase allocations to equities, especially if one is underway. This asset class is the case for majority of Indians. Given this, a disciplined asset allocation with a focus on longer term goals is imperative, and equities continue to be an important avenue to fulfill long term goal obligations. Be patient investors, and do remember, time in the market is more important than timing the markets. Thank you so much for your patience and listening. Happy investing.